Assalamualaikum everyone. Welcome back to our analysis of risk management. Earlier, we look at the risk management process. I was saying that for the bank to make good profit, the first thing they need to do is to ensure that they make a good loan. Right, the loan must be a prudent loan. So, in a sense that there must be a process whereby uh, the bank would observe in order to ensure, to guarantee that all loans issued by the bank are good loan, meaning that the bank would be able to recover the loan if the loan default. So in order to make a good loan, the bank must follow the what we call the risk management process, the RMP. That is, we want to know what are the risks in the loan, how to measure and how to mitigate and how to report and monitor. So if you take, for example, a particular exposure of 100 billion of loan of murabaha that is funded by deposit funds. So we are looking at a commercial bank where funds are mobilized from the depositors, the household sector, from the businesses, from government sector. And these deposit funds are basically loan supplied by the depositors to the bank, where the bank is considered to be a borrowing party, and then the depositors are the lending party, where bank would pay depositors an interest rate and or profit rate of 3% per annum for the placement made that is 100 billion. So when the deposit has matured, then the depositors will redeem the deposit amount of 100 billion plus the 3% or the 3 billion interest income. So this deposit fund is now used by the bank to make a loan or murabaha, where the finance charges will be at 10% interest rate or profit rate. So in a sense that when we look at the revenues generated from the loan or the financing, it would be 10 billion, which is basically 10% multiplied by the size of the loan or murabaha, and that will give us 10 billion. And the cost of fund or the cost of deposit would be 3% times 100 billion, and that will be $3 billion, and the bank will be able to enjoy a gross earning of 7 billion. 10 billion minus 3 billion, that will be gross earning of 7 billion. And we know that when the bank run the banking operation, they will have to incur overhead expenditure, so that need to be accorded into the profit and loss statement. Let's say it is 1 billion, and at the same time, when the bank make a loan or murabaha, there is a possible loss from the loan, and these losses can be based on the various risks that we know very well that all banks are facing when they make a loan. The exposure is subjected to potential losses or risk, and this risk can be those from default, which is credit risk, market risk, business risk, operational risk, liquidity risk, Sharia non-compliance risk. So once the bank make a loan or murabaha, this exposure will be exposed to potential losses or risk arising from the default market, operational liquidity, and Sharia non-compliance, as well as risk arising from a deposit where the bank is not able to honor any withdrawals that will cause depositors to panic, and there can be a bank run if a bank simply cannot honor withdrawals of deposits. So So that is why when I was saying earlier, when the bank make a loan or murabaha, the loan must be a good loan. It must be a prudent loan so that we can minimize all of these potential losses arising from credit, market, operational, liquidity, and Sharia non-compliance risk. And thus, risk management process is a very important procedure to ensure that that we are able to understand what are the risks involved in making the loan and where are the risks coming from. So this is risk identification and risk management. We have to quantify the risk so that we know the extent of the risk in terms of money, so that this risk can be incorporated in the pricing of the loan. Because risk and reward are interrelated. So the greater the risk, the more financing charges, and the lower the risk and the lower will be the financing charges. And we can see that risk measurement is one of the most important aspect of the risk management process, so that we are able to forecast the danger to the exposure, and we are able to make possible preparation for the losses in terms of the loan provision that we make, as well as capital that we have always there to ensure if there's any extraordinary losses which is beyond the losses forecasted, then the capital will be able to absorb those losses. So these are risk management. And the last one would be risk mitigation. That is, we must be able to see that the risk in the loan are those that are acceptable, that are within our risk appetite and risk tolerance. If these risks are not within that borderline, then it should be rejected. The loan should not be offered. And for this reason, risk mitigation is a very, very important component of the risk management process. For example, if the loan need to be guaranteed with more asset, then it should be done in that manner. We have to inform the prospective borrower that if you want the loan, then you have to put more of your asset as collateral, or bring in some guarantors to ensure that the risk to the loan in the loan is within the risk tolerance of the bank. So here, as we see that the bank will be facing so many potential danger that can impair the financing operation. Number one, credit risk. What is credit risk? These are potential losses arising from loan defaults. We know that banks give loans or murabaha to people they don't know at all, and if these loans are not properly processed, then we can end up giving loan to those people who are not viable, and instantly, in a couple of months, we can see that there will be default. So loan should be processed, should be assessed and evaluated using the proper risk rating model to ensure that the loan that the bank make is always a good loan. So we do not want ending up to become banks in the US 2008 subprime crisis, where the bank make a lot of subprime loan that eventually defaults and causes the US financial crisis. Market risks are essentially potential losses arising from changes in the level of interest rate and forex rate. So we can see that, for example, if there is economic hyperinflation or inflation that require the central bank to control the interest rate, or to increase the interest rate, that will increase interest rate from 3% upward, and this will of course affect your cost of deposit, as well as your interest revenue or financing revenue for Islamic bank. And the revenues may explode, the cost of deposit may explode. At the same time, default can also explode because the borrowing party now will have to pay higher interest rate, which they could not afford, and this will lead to defaults, and that will increase or see the explosion of the loss provision, which is not good for the bank. So this is again the connection between credit market risk and credit risk can be established. Operational risks are potential losses arising from human error, from human negligence, from fraud and breach of trust that can impair banking operation. It can also be caused by system error, computer hacking that can easily adversely affect the bottom line. Liquidity, and we can see that in Islamic banking we got Sharia non-compliance risk, which is one form of operational risk where any violation of Sharia discovered in product program and all other aspects of banking operation. This would trigger SNC. So Islamic Bank need to rectify and find a solution if there is SNC. Liquidity risk is again losses arising from mismatching of fund. We know that deposit funds are short-term funds, 1 to 5 years, whereas loans and murabaha are funds that are given away for a long term, for to 10 or to 30 years. So if there's a lot of mismatches between deposit fund and loan and murabaha, and if that and when that happens, when we have a lot of the asset are tied into long-term financing, so when there is a sudden withdrawals of deposit, the bank will not be able to honor the withdrawal due to the impending loss if they were to sell the loans in order to make the redemption. So this is something that depositor do not like, and they will withdraw, and if none is happening, this panic will cause the bank run, and eventually the bank will get into bankruptcy or into insolvency, as what we see in the Silicon Valley in March 2008, what has happened to Silicon Valley Bank. Okay, so it is very important for us to see that risks are properly identified, they are properly measured, and they are properly mitigated before the loan is given away. The bank must be able to follow these processes of risk identification, risk measurement, and mitigation to ensure that the bank make a good loan and not a bad loan, because a bad loan will eventually turn into default that can cause severe losses to the bank. Okay, guys, we can stop here. Inshallah, we can continue further to further discuss about this risk management process. Thank you very much. Assalamu alaikum warahmatullah.